Okay, so as part of these live sessions, we are going to do a very quick revision on chapter number 2, actually. So you people have detailed lectures, so I'm not going to go into detail of everything. I just want to do some, touching base with some important topics, some quick revision, few areas I just want to discuss and want to do one or two short examples. So you can consider it as a recap of the chapter and not the entire chapter, okay? So the chapter number 2 is actually this, strategy, financial strategy evaluation. The main topics which are covered here and which we are going to discuss for today: cost of equity, and of course cost of debt. And then as part of cost of equity and debt beta, we will talk about asset beta, equity beta, the relationship between the two, systematic risk, unsystematic risk. We'll talk about today weighted average cost of capital, WACC. We'll not go into deep details because we already have covered it before, but we will talk a little bit. Then we will definitely talk about these profitability ratios and shareholder ratios. So it is about assessment of performance of a business. This is very important part. So these two sections I intend to cover today. One is this one is this one, okay? And we will have a quick walk through all of these things. Of course, we talk about that financial management is about financing decisions, investing decisions, and dividend decisions. Three different types of decisions are taken. The first one is always like investing decisions, which projects we should invest and which projects we should not invest. And you do that through investment appraisal. And when you decide that, okay, this is the project we want to invest, the second question comes that where the money will come from. So then comes the financing decision. So are you going to do equity financing or are you going to do the debt financing, which is more appropriate? And how the mix of equity and debt financing is going to impact your cost of capital, your WACC. A very, very, very important concept, cost of capital. And finally, when you have financed that project and of course, the project starts giving returns, the last decision comes as dividend decisions. That, okay, fine, now we are making money. Now how much dividend we should be giving out? So three pillars of these financial management: investing decisions, financing decisions, and dividend decisions. In this chapter, we are focusing more on financing decisions. The source of finance, equity finance, debt finance, and then, of course, there is a cost of equity finance, which we call cost of equity. And then there is a cost of debt finance, which we call cost of debt. And when there is a mixture of these two, then we call it weighted average cost of capital, which means average of cost of debt and cost of equity. Okay, so now remember that as a general principle, it may look very basic to you people because some of you have already watched AFM lectures and almost all of you have passed your ACCA AFM or F9. So you should be familiar with the concept, but I just want to make a very quick, reminder that in most cases, so you've got cost of equity, the money coming from the shareholders, and you have cost of debt. This is the cost of money coming from the outsiders. So you take equity, you must give them some return to the equity shareholders. You take debt from some source, outsiders, and you must pay them some interest, and that is the cost of debt. In many cases, cost of equity is higher and cost of debt is less, okay? So let's suppose you've got cost of equity probably 11% and cost of debt might be 9%, which means that debt is cheaper. So you have understood this concept from past, but I'm just making a quick reminder that in most cases, generally speaking, debt is cheaper. The reason for being debt is cheaper, that we start with the concept in finance that higher the risk, higher the return. Wherever there are more risks, returns are expected to be more. And because debt providers, they take lower risk, With the debt, the bank or the entity, the individual who is providing the debt, they are taking less risk because they have agreed on a fixed rate of return, the interest, 7%, 8%. So your debt provider says, you must give me 8% per year. Now you make profit, you don't make profit, I'm not bothered about that. Bring me my 8%. So they are secure as in terms of the earnings. And then when it comes to the return of the principal amount or the return of the debt, they again are quite safe because they have taken the collateral, they have taken mortgage from you. So if you do not pay back their money, they will sell your assets and recover their money. So debt providers are generally facing lower risks, and therefore they are willing or they are happy to accept 9% as well. Whereas the equity providers, they face higher risk because with equity providers, we do not have any commitment on profits or returns. We tell them that if we make more, we give you more. If we make less, we give you less. We make nothing, we give you nothing. And it is possible we make a lot, but we don't give you anything. This is also possible, no dividend. We might be we might be making huge profits, but we decided not to give any dividends. So this is in terms of the profitability. And then as far as the original investment is concerned, so you have invested the money. If the business goes well, you can take out your money in 2 years. If the business is not doing very well, probably you will take out your money in 5 years. And it is also possible that the business goes bust and all of your money will be lost. So there is no assurance, no guarantee to the equity shareholders, to the equity providers, to the owners of the business. And they face higher risk, and therefore they take or they expect a higher rate of return. Okay, this is what happens in most cases because they face risk. Equity providers, they face risk. Okay, so you can assume fairly there would be there could be some specific situations where the cost of debt goes up. There could be some such specific situations, but these are rare situations. As a general principle, you should remember that equity is expensive, debt is cheaper. One very big factor on cost of debt, one very big factor on debt is the tax savings. Okay? Because when you pay interest on debt, that interest actually you show it as an expense, and that decreases your cost of debt. For example, if I take a loan at 10% from a bank and my tax rate is 30%, so I took a loan for $100, and on that $100, I have to pay interest, which is $10. So I'm paying to the bank 10%. To the bank, I'm paying 10%. But the post-tax cost, we call it post-tax cost of debt. To me, it is only 7% because I would say 10% into 1 minus t, and my t tax rate is 30%, which means 1 minus 0.3. So it means 10% into 7%. My real cost of debt is only 7%. Because when I take this $10 into my P&L, I will pay less taxes because as my expenses go up, my profit goes down, my tax goes down. So remember, even if I'm paying to the bank $10, the real cost to me for this loan is only 7%. And that is a significant decrease. From 10%, it straight goes down to 7%, which is a very big factor. Like when you talk about huge financing in millions of dollars, even 0.2%, 0.5%, 0.1% matters. I'm here talking about 3%. 3% is the amount on which many businesses, they survive actually. So it's a huge, huge, huge tax saving. So that's why generally debt is cheaper. Number one, because the debt providers, they face low risk. Number two, the entity, the company, they get tax savings on the cost of debt, and we call it post-tax cost of debt. Okay. We talk about here there are two types of risk. I don't want to go again into details. I'll just explain the definition because this is not really something very important for today's discussion. Unsystematic risk and systematic risk, actually. See, unsystematic risk is, remember, whenever you do a business, by the way, when I say risk, what type of risks are faced by a business? Businesses, they face two types of risk. One is called the risk of the business risk, which means that this is the risk which is associated with the nature of business. For example, some businesses are considered as high risk and some businesses are considered as low risk businesses. I would say that a restaurant business is a high risk business as compared to a supermarket, because supermarkets have very stable sales. Market goes up, market goes down, but their sales continue. Restaurants have a different perspective. If they work, they make a lot of money. If they do not work, a lot of money is lost, because you have invested in decoration and renovation and furnishing. All of that money will be lost. You cannot take out. You see, I put $100,000 in a supermarket, and if it does not work out, I can take out 80,000 by selling the goods in it. But if I put $100,000 in a restaurant and that venture does not work out, probably out of 100,000, I might take out only 25 to 30,000. It's a huge risk business. Similarly, software house, if it works, if it clicks, it will give you millions. And if it does not, you would end up paying salaries and nothing is in your hand. So risk, when we talk about risk, so some risks are associated with the nature of business and some risks are associated with the capital structure. Okay, we call it capital structure. What does that mean? Let's suppose that this is one road. There are two restaurants opposite to each other, just on the same street. They offer the same type of food. They both are offering pizza. Their prices are same. Their quality is same, their location is same, their size and scale and decoration, a lot of things are same. So it looks like that these businesses, they have the same risk as in terms of business risk. But when you find out that this business has huge debt and this business has no debt, so it means that when it has huge debt, so in terms of, so if the sales go down, if the business goes down, they will have to pay the interest cost, and that business is facing risk because of the debt. And this business has no debt. So even if the sales go down, they don't have to pay any interest. So you can say that their business risk might be same, but the risk because of the capital structure is different. So businesses are facing these two things. One, which we call business risk. The other one, which we call risk, which is associated with the capital structure, which means how much equity you have, how much debt you have. And as the debt is increasing, the capital structure risk is increasing. Okay. So this is another one small piece of concept which you need to fit somewhere in your mind. So what I'm trying to do, this is our first live session. So I'm just revisiting some of the very basic concepts very quickly, which I want you to have just right on top of your head. Okay, now we talk about systematic risk and unsystematic. This unsystematic risk is called specific risk. This is the risk which is associated with a nature of business, with the nature of business. Okay, so for example, I said that a restaurant business has a higher risk than the supermarket. So these are called unsystematic risk. The risk which is associated in restaurant or which is associated with supermarket, these are called unsystematic risk. Unsystematic risk is actually due to the nature of business. Now, here, sometimes we are using the word diversification here. Diversification because sometimes we say that you invest in different businesses. Imagine that you are a large investor. So you invest in restaurant business, but then you say, okay, I'll invest a little bit of my money in restaurant business. Then I will also have investment in supermarket. I would have investment in some furniture manufacturing. I would have investment in some other retail or whatever. So what you are doing, you are actually diversifying your portfolio. You can imagine investing in businesses by directly investing in businesses as, equity or whatever, or buying some shares or whatever you may call it. Okay. So you invest in different businesses in small amounts, like people who buy shares, they buy shares in different companies. What they are actually trying to do, they are diversifying their portfolio. And when they diversify their portfolio, we assume that they bring the risk to a very negligible level. Risk cannot be eliminated, risk cannot be zeroed out, but it can be reduced to a very low level. By the way, this is a concept which is given in the books, that through diversification, you bring down the risk to a very negligible level. This is an academic concept. In real life, the situation is actually slightly different. It is not so much reduced as it is assumed. But anyways, we go through the academic thing. This is called unsystematic risk. Unsystematic risk is within your control. Okay. You can avoid unsystematic risk straight away. What you can do, oh, software house is a very risky business, I'm not investing in it. Restaurant is a very risky business, I'm not investing in it. So you can actually avoid it, or you can manage it, or you can minimize it. Many things you can do with that unsystematic. But when it comes to systematic risk, this is the system, this is a risk within the system, which means that this is the risk which is faced by the economy. And it is not faced by one entity. It is not faced by one nature of business. It is faced by all the business within that economic environment. It could have different reasons in different times. Sometimes the systematic risk goes up because of the political instability. Sometimes it goes up because of some geopolitical issues. Sometimes it goes up because of the local inflation. Sometimes it changes or it increases or decreases because of unstable currencies or exchange rates, inflation rates. So these are economic conditions within that country or within that economy where you are investing. And these cannot be avoided. So we actually are not worried about systematic risk. We are more worried about unsystematic, because this is which is within our control. You cannot control systematic risk. This is in the market. This is in the air, okay? So systematic and unsystematic risk. Then we talked about beta factors. This again is a concept which we discussed in detail in FM and also in AFM. I have a very, very, very detailed lectures on this thing, because this is a concept which sometimes confuses students, because you you surely will have equity beta, asset beta, geared beta, ungeared beta. Then you re-gear the equity beta into the debt beta, or you convert the debt beta into the equity beta. A lot of hustle will be there. So you should be very clear on that. I have 2-3 very detailed lectures on beta. Okay. So, but in any case, beta is the measure of risk. When you say that risk is there, and you say that I want to manage the risk, or I want to calculate the risk. So when you want to calculate something or manage something, you need to know how to measure it first. And then only you can say, here the risk is more, here the risk is less. When I said that restaurant business is more riskier, is riskier than the supermarket, you should ask me, how do you say that? How do you say that restaurant is more risky? And if it is riskier, then how much it is? Is it 5% more riskier, 10% riskier, 20%? What it is? So there should be some measure. So beta is actually the measure. Beta is the measure of the risk. Through beta, you measure the risk. The higher the beta value goes up, higher the risk is. Okay. So there are, for example, when I said that restaurant business is riskier than supermarket, so I can prove it. For example, that see, supermarket has a beta factor of 1.2, restaurant has a beta factor of 1.8. You say, oh, now I see, that's like pretty much bigger risk, because now you have quantified it. Okay, so beta factor. Now, the value of beta equals to 1. When you say 1, beta factor 1, it means that this is the, okay, let me just go back a little bit, because I don't want to go into detail, but this is a topic I just also do not want to leave it totally untouched. You see, this is your economy. And within this economy, there are different companies. There is a showroom, there is a furniture manufacturing, restaurant, software house, construction business, banking, insurance, and so on and so on. And some of them will present higher risk. Some of them will present lower risk. Okay. So you can say that some of them will have a risk value of 1.2. Some of them will have a risk value of 1.3, beta value of 1.3. Some of them will have a beta value of 0.8 or probably 0.9 and so on. So all of these businesses, they present different levels of risk. So it means that they have different values for beta. If you find out their average, average risk, we call it the average risk presented by the market. And for the average risk, the beta value is always equal to 1. So when I say beta value 1, it means that this is the average risk presented by the market. See, imagine now what I'm saying here. Now, if I say that the average risk in the market is 1, and there is a business called Alpha company has a beta value of 1.3. So when you say that Alpha company has a beta value of 1.3, market is 1. So it means that Alpha company is presenting higher risk than the market average. Alpha company is presenting higher risk than the market average risk. Okay, so I can say that the market is presenting, for example, whatever is a certain level of risk, Alpha is presenting higher risk than the market average. Now, why I am saying that? Because remember that the company with a beta value of 0.8 was giving a return of 6%. A company with a beta value of 0.9 should be presenting probably a return of 7%, because higher the risk, higher the return. A company with a beta value of 1.2 probably should be presenting 9%. And a company with a beta value of 1.3 should be offering return 11%. So if you want to invest in this company, investors are expecting 11% return. If you invest in 0.8%, 0.8 beta, which is probably the supermarket, you might be happy with 6% return. See, remember, investors' expectations, they change with the nature of the project. I am sitting here, I am an investor. You come to me and you say, Mr. Ali, I have this supermarket business. Would you like to invest in 100,000? I say, okay, I'm investing 100,000 in supermarket. Give me 6%. And then another person comes in the same day, the same time, in the same room and says, I have got a restaurant, and would you invest in my restaurant at 6%? I say, no, in restaurant, I would invest at 11%. He said, but you just invested with someone else at 6%. I just saw you gave him money for 6%. I say, yeah, because that was supermarket. But if it is restaurant, I'm expecting 11%. So investors, they always see where they are putting their money in, and according to the risk, they make their expectations for required return. Expectations, I will use the word, okay? It's not a fixed interest, but these are expectations. I'm not talking about debt financing. I'm talking about equity financing. In equity financing, there are no fixed percentages, but there are at least expectations. Because when supermarket came in, he said, I make approximately 6%. I say, I'm fine with that. Restaurant comes in, says, I'm making approximately 6%. I say, I'm not fine with that. If you could think that something like 10, 11, 12%, I would be interested, okay? So it's expectation. Anyways, so it means that these businesses, they present different levels of risks and they have different values of beta. As a result, they have different returns. They are giving different returns. So when I take the average of this, the average risk is called 1, beta value of 1, and then I have an average return. Average return probably I can say 9.5%. Okay, so you can say that in any market, businesses, they present different levels of risk. The average risk is called 1. And then at the same time, these businesses are offering different levels of returns, and the average return is 9.5%. So it means that for average beta, the average market return, we call it RM, market return. So the market return is 9.5. Now you come in and you say, Mr. Ali, I've got a project which is offering beta of 1.3. No, you did not tell me. You said that I have a project. I've got a project, and would you like to invest in that project? I say, okay. So I have got, what do I have? I have here. Okay. So you come in, you say, there's a project which requires $100,000 investment. Would you be interested? I say, tell me, what is the beta in that project? And you say, the beta is 1.3. I say, oh, beta is 1.3. So it means that I should be getting more than 9.5%. Because for beta 1, which is a lower risk, because for beta value 1, market is offering 9.5%. This particular project is riskier than the market, and therefore the return should also be more than the market. So I am not going to expect 9.5, I will be expecting more. How do I calculate that? And that what we say cost of equity using the CAPM formula, capital asset pricing model. We said that RF plus beta into RM minus RF. So RF is the risk-free rate. We say, what is the risk-free rate in the market? We find out that if you put money in the bank, the risk-free rate is 4%. The beta of this particular project is 1.3. And the RM, market return average, is 9.5. And minus 4, the risk-free rate. So how do I now calculate that? If I have my calculator somewhere on my table, I don't, so I'll use my phone, or if somebody could help me. So what I say to them, what I tell them that, guys, listen, 9.5 minus 4 is 5.5 times 1.3 plus 4. You have to give me 11.15%. So if you give me 11.15%, this is what I expect. And this is cost of equity in this case. So for a project with a beta value of 1.3 and risk-free rate of 4% and RM with 9.5%, we expect for this particular project 11.15%, okay? 11.15%. We use this method, we call this formula CAPM, and sometimes they call it CAPM or CAPM. Some tutors say CAPM, I call it CAPM, capital asset pricing model, and we got 11.15%. I think that you people remember this thing from your FM. If you have any question until here, please ask me, or I will continue further. So we understand the basic concept that how beta factor it impacts. And of course, as the risk increases, the value of beta increases, the value of beta goes up, expected return goes up. If they had asked me in the same situation that RM, for example, RM was 9.5%, RF was 4%, and they came up with another project which has a beta of 0.8. 0.8. Now, RM is for beta 1. Remember, RM value, RM is market average, and market average is always for beta 1. And this particular project is giving 0.8 beta, which means this particular project is very safe. It is lower than the market risk. So then how much will be the shareholder expectations? It would be 4% plus 0.8 into 9.5 minus 4. And I'll take my calculator, 9.5 minus 4 times 0.8 plus 4. That's 8.4%. I am actually happy or willing to invest in this project at only 8.4%. Market is giving 9.5. If I invest this money in the market, if I take my 100,000 and I put 10,000 in one company, 10 in another, 10 in another, I divide my 100,000 in 20 different companies, in the shares of 20 different companies. Some are offering more return and more risk. Some are offering less return and less risk. So if I put my 100,000 in those 20, 30 different entities, I will be facing a risk of 1 and I will be earning a return of 9.5. But I decided not to invest in the market. I say I'm investing in this business, which has beta of 0.8. So it has less risk. It is stable business. And therefore, the return is also less. And I'm happy with that. Okay. Now, this is one thing. Now, before we said, so that there are two types of risk. We said that there are two types of risk. If you remember, I said that one is called the business risk and one is called the capital structure risk. Capital structure risk. And then now I'm talking about beta, and I say that beta is the measurement of risk. So you might be asking me that beta is the measurement of which risk? Do you mean that beta is associated with the business risk? Or is beta associated with the capital structure risk or with both risks? So if we have two different types of risks, do we also have two different types of beta? That is a very genuine question which you should have asked me by now. You did not. I give you a chance. I ask you, if you have any question, please ask. I was expecting that somebody should ask me that if we have two different types of risks and beta is a measure of risk, then beta is a measure of which risk? This is what you should have asked me so far. Anyways, remember, there are two types of beta. We call it asset beta. Which is called BA. And we call it equity beta. And we learned this concept in FM as well. I'm just doing a quick revision because today we are meeting for the first time. So I don't want to go very fast. I'm just trying to make a bridge that FM and AFM. Okay. So there are two types of betas, asset beta, BA, and equity beta, BE. This value is always higher. This value is always higher, and this value is always smaller. Why? Because this has only the business risk, and this has the business risk plus the capital structure risk. The risk as a result of adding debt. Capital structure means when you have debt inside. So when I say equity beta means the risk which is faced by the equity shareholders. And that includes two types of risks, risk as the nature of the business and the risk which is arising due to the addition of debt into your capital. So equity beta is always a bigger value because it has two types of risk. So I can say that, let's suppose for a particular business, equity beta comes out to be 1.3. Then your debt beta probably is 1.1, even less or whatever. But it has to be more, it has to be less than 1.3 because it includes only one component, A. But it includes two components, A plus B. The business risk and the capital. So both risks are accumulated within the equity beta. Okay, so remember, both risks are accumulated, and sometimes the questions, they require us to convert equity beta into asset beta, and it is possible. How do you convert equity beta into asset beta? You say that beta asset, again, a concept from FM, F9, and very detailed lectures for AFM also available. So go through them. I'm just doing a very quick revision on betas. I have a 40 minutes lecture. There are 2 or 3 lectures of 40 minutes each on beta, because this is one of the very important areas when you will do capital structure question, when you will do business valuation questions, when you will do investment appraisal. Because it will be used in the calculation of WACC, it will be used in the calculation of valuation, it will be used in the calculation of investment appraisal. So you cannot just simply, it's just like you are cooking food and you don't have salt. Beta is salt. It might not be a very big concept, but it is so essential concept that nothing can be cooked without it. So beta asset is equal to beta equity. There are 2 formulas, but ultimately both of them are same. 1 plus 1 minus T into debt over equity. You call it like this. This is one way of doing it. Or you sometimes in some books, they write it like this. They call it value of equity divided by value of equity plus value of debt into 1 minus T into BE, beta equity. The both formulas are same actually. There is no difference in these formulas. I mean, this formula actually can be converted to this one, or this can be converted to this one. You can remember any one of them. Okay. Actually, let me show you how do we, why I say they are same. And then what is the relation? Actually, let's not call it value of equity in order to make it equal. Value of equity and value of debt. No, we call it equity over equity plus debt into 1 minus TBE. So if I want to solve it, I would divide this thing, equity divided by equity. So I'm dividing everything, equity by equity, plus this is one thing, D into 1 minus T, and I divide it with equity. Remember mathematics? So there are 3 terms in this formula. One term is this one is this one, and one is this one. And I'm dividing all 3 with equity. So then what will happen? This will cancel out. This will cancel out. And when you will rewrite this thing, it will become 1 over 1 plus 1 minus T. And this is D over E. So D over E. The same formula which I wrote here. This one. So it's the same formula. Now, if you want to see, okay, Mr. Ali, what is the logic behind that? What I'm doing here? So do I have to remember it? Yes, you have to remember it, but you can think like this. You can think like this with this formula, that beta of asset. I say that asset beta is a smaller value because it has only one risk, is equal to beta of equity, this one, multiplied by this equity over equity plus debt into 1 minus T. So this is actually what I'm doing, 1 minus T. So this is my proportion of equity. Equity over equity plus debt into 1 minus T. So this part is actually the proportion of equity within total capital. So let's suppose my equity is 40%. So what I do, if my equity is 40%, I would say, let's suppose my beta equity is 1.4. So I say 1.4 beta equity into this proportion, which is 4 equity over 4 plus 6. If it is 40%, then 40 and 60, so 4, 6 into 0.7. So this is actually the proportion, which is equity proportion. It is something like 37%, or then I multiply this. So this is actually your equity proportion. So how do you convert if it comes to your mind, oh, the formula is very difficult. I don't want to remember the formula. I can't remember the formula. What do you do? Nothing. What do you want to do? Convert equity beta into debt. So multiply equity beta with this, the equity proportion. That's all. This is equity proportion. And if you have to convert the asset beta into equity, for example, because in this case, I said we have equity beta, how much will be asset? But if you want to convert the other way around, then you will say asset beta multiplied by this E plus D into 1 minus T divided by E. So it will go there and opposite side. So this conversion will always happen. Whenever you get beta question in exam, we call it, by the way, geared beta and ungeared beta. Where do we use these two betas, by the way? Now that is the question. Okay, I understand that there are two betas. One is called asset beta, one is called equity beta. Asset beta is the one which has only one risk. Equity beta will have both the risk, two risks. Where do I use them? Where do I use them? Remember your CAPM formula for cost of equity? You said that cost of equity was equal to RF plus beta into RM minus RF. So you might be asking me, Ali, which one is this beta? Which one is this beta? Is it asset beta, the smaller one, or is it equity beta, the bigger one? Which one we should be using it? Again, knowledge brought forward from FM, F9, and that is why I say, so far, whatever I have discussed with you so far, there is nothing new which is from FM. All of these things I've explained to my students in F9. Now, I know that some of you people have not done F9 with me, and that's why I'm going back, because I'm not sure how much you covered in FM. So we are making, and that's why I said that AFM and FM are so related to each other. Okay, so your question might be, which beta should I be using here? Very straight. Is the company geared company? Geared, which is called levered. Geared levered means where you have the debt. Or do you have an ungeared company? Ungeared company means there is no debt. So if you have a geared up company, which means that there is leverage, there is debt inside, then you will use that beta of equity, which inside has that the debt component. But if you say this business is 100% equity financed, this business is 100% equity financed, which means that there is no capital structure risk. So in that case, you should be using beta asset. In that case, you should be using asset beta, which means a beta which is ungeared beta. You should be using ungeared beta, no debt. When do you use? If you have equity finance business. Because when I told you that there is a beta in the market, which is beta equity, and that is 1.4, and that includes the capital structure risk and the business risk, both of them. So should I use it here? 1.4. My question is that my business is all 100% equity financed. My business does not face the capital structure risk, and therefore this beta is not relevant for me. My beta should be lower. I should be, if I put here 1.4, it will give a bigger expectation from this business. Whereas this business is 100% equity financed. So I should be actually, ungearing it. It is called geared beta. When I say that it has some debt structure, it is called geared beta. I need to ungear it. Ungear it means I need to take away the impact of debt. I have to remove the risk of the debt. And when I remove the risk of the debt, that would be called ungeared beta. And that might have a value of 1.2. And then this 1.2 should be used if this business is 100% equity financed. And how do you ungear that thing? How do you ungear? You will ungear like this: beta asset is equal to beta equity multiplied by equity proportion divided by equity plus debt into 1 minus tax rate. 1 point BE is 1.4. How much is equity? 60%. How much is equity plus debt? 6 plus 4 into 0.7, whatever, and you found it out. So it's not really very difficult, provided you go through the concept. So I have actually, I never thought that I would speak so much about that, because you already have got lectures on this topic on your course page in much more detail. But because we started the topic, so I could not stop myself. So, Beta, any question until here, please ask me. Okay, so, okay, who asked this question?
It was me, Stephanie.
Okay, Stephanie. You asked the question that why do we do this gearing, geared beta convert to one gear and ungeared convert to geared? Why do we do that finally? See, in many situations, you will not have, so for example, you come to me and you say, Mr. Ali, there is this furniture business, furniture manufacturing. Do you want to invest in this business? I say, let me think over it. And when I say, let me think over it, do you think that I will sit down at night and I will start seeing the stars and moons and I'm thinking, should I invest or should I not invest? When an investor says that, let me think over it, it means that he will perform some calculations. He will not sit down and just start thinking. So what I will do now, so you came to me a proposal with the furniture, okay? So I say, what is the market return? Risk-free. Risk-free rate is 4%. That I know, okay? But of course, I'm not going to invest at 4% because 4% is risk-free rate and furniture business is certainly not risk-free. Then I say this furniture business is in which market? This is the local market. Different local markets have different risk levels, okay? A local market in Somalia, a local market in Afghanistan, a local market in Turkey, or a local market in UK, the furniture. Furniture manufacturing in UK is different than furniture manufacturing in Turkey, or furniture manufacturing in India, or furniture manufacturing in Afghanistan. They have different local environmental risks, okay? So I need to see where I'm investing. Am I investing in Afghanistan or am I investing in UK? So anyways, I say, okay, this is the size and scale of the business. This is the furniture factory. I ask you, provide me some details. What is the size? You said this is a company with a capital of this much size. This is what they make. This is what they do. And I find a similar size of another company which is already existing in the market. And I say, what is their beta? So I find out that their beta is 1.3. And then what is this market offering in general? This is UK market. So this market is offering something 8% on average. Okay, so now that thing makes a little bit of sense, but not full sense, because I need to do my study. I asked you, give me 2 days, and I will tell you if I'm investing or not. And if I invest, what do I expect? So first thing, because we are investing in UK, I find out what is the risk-free rate in UK, what is the average market return in UK, how much is the beta of a similar furniture manufacturer, that is 1.3, and I say, okay, can I calculate my cost of equity as 4% plus 1.3 into 8 minus 4%, RM minus RF? This is one way of doing it. So I was actually about to do it, but suddenly I realized that there is some problem. The problem is that this beta, which you have told me for this company, this is 100% equity financed project. Or maybe this is, okay, let's call it, this is 100%, okay, this is this is a geared beta because it has equity plus debt. And I remember you told me that your project will only be equity. You said that the project in which you are inviting me to come and invest as shareholder, you said we don't have any debt. Our project is 100% equity financed. Now, this beta is called geared beta. And I cannot have this thing because here equity plus debt. Their beta 1.3 includes both risks. It goes vice versa as well. It can go vice versa as well. For example, you can say that this particular project is 100% equity financed. So it means that this beta has only one risk, which is the business risk. It does not have debt financing, but the project which you offered me, it does have some debt. So how much debt do you have? You said we have got 70% equity, 30% debt. So now I need to convert this beta. So this is my asset beta, and I need to convert it to equity beta. So I say asset beta is equal to equity beta into equity, which is 7, divided by equity plus debt, which is 3. Tax rate is 70%, is 30%. This is 0.7. Your value is asset beta because it is ungeared beta. The beta which you gave me is called ungeared because it did not have any. I could not use your beta because it was ungeared. My company is geared company. I need to consider the debt factor as well. So I say, okay, this is 1.3 is equal to BE. And then when I make it on the other side, I would say 1.3 multiplied by 7 plus 2.1. It is 9.1 divided by 7. And then I say 9.1 divided by 7 times 1.3, it is 1.69. So I should be using a beta value of 1.69. Because when I went to the market, my project and the market project could be different. My project is equity finance, your project is debt finance. So I cannot use the market beta, I need to convert it. Are we clear?
Yes, sir. Thank you.
Now, this is actually the beginning of that thing. Because what we learned, we said that because some businesses are geared businesses, which means they have equity and debt, and therefore their beta is geared beta, which you call asset beta. Some businesses are ungeared businesses, which means their beta does not have debt. And we said you convert them. So I took it as 100% equity, 100% finance. But sometimes it does not happen because what will happen? Both are geared. This is a geared business. Remember, I said I took a business 1.3, the beta value in the market. And then I said that the business which we invest is ungeared, for example. So you said that let's remove the concept or let's remove the element of capital structure risk. But it is possible that both businesses are geared. Both businesses are geared. So if both businesses are geared, can you use 1.3 here? Yes or no? Can you use 1.3 now?
I would say yes, but I think it's a no. I think we have to ungear and then gear again.
Because it is 1.3, but the thing is that here the capital structure was 70% equity, 30% debt. Here the capital structure is 50% equity, 50% debt. They both have debt. This is a geared beta. It has a debt. This is going to be a geared beta. Do you think here the beta value would be more or less?
It would be more.
It should be more, something like 1.4, because it has more debt. So what you need to do, first, from this 70-30, this is geared. You convert it into ungeared. You remove the effect. And while doing ungearing, you will use the ratio of 70-30. With 70-30 ratio, you will ungear. And then you will re-gear it.
With the, okay.
Then you will re-gear it with the ratio of 50-50.
Okay.
Do you understand?
Now, yes. Thank you very much. I think we had it in Moonstar, with something similar, gearing and ungearing. The question.
There was a geared beta, and that gearing was 70-30. So using that 70-30 ratio, you will ungeared. Ungeared means I remove the aspect of debt, but then I need to add debt into that with the ratio of 50-50. So I do gearing. The formulas will remain same. The formula which I will play, beta asset is equal to beta equity into equity divided by equity plus debt into 1 minus T. The only difference is when I will use it to ungear, I will use 70-30 ratio. When I will regear, I will use 50-50 ratio. As a result, it will become 1.4, 1.42, 1.43. Okay. Okay, so we done with this thing. Although it was a quick recap, but we went into more details than expected and we spent more time. So this is the same formula which you have for, RF plus beta into RM minus RF, which is market premium, market return. It says that technique demonstration, Mantra company has an equity beta of 1.5. Assume there is a market. Okay, now here you should understand. It says that there is a market premium for risk of 4%. When it says market premium, it does not mean that it is RM. It means that it is RM minus RF already. So they have not given you RF in this case. If you notice, they are not telling you RF. They are telling you RF 2% actually. Assume there's a market premium for risk of 4%. Okay, 4%. So it means that it should be 6%, 2% plus 4%. They're not saying that it is average market. So you should take 6%. Okay, 6% minus 2% and into beta, which is 1.5 plus RF, which is 2%. So this should be the answer. 2% plus 1.6 minus 2, 4 into 1.56. And the answer should be 8%. So this is done. This was nothing difficult. Okay, now there is a concept here which is called yield. Very important concept. Again, I have given one detailed lecture like 40 minutes, and then there is a separate lecture I gave it a name, revision of yield. Please watch that lecture to understand, because yield is something which is, and then there is yield to maturity and yield changes, and how the yield changes every time on bonds. It's a very important concept. There are 2 lectures on that, separate, but I'll just give you one clue here that in very brief, what is yield? Yield is actually, you can call it the IRR or you can call it the actual return which you get on any investment. For example, you have a bond, you purchase a bond, the bond has a face value of $100 and the bond gives you coupon on the bond, which means the interest rate is 5%. So it means that you get interest every time as $5, okay? Because $100 into 5% means $5 interest you get. But for some reason, the market price of the bond, it goes down. The market price of the bond is now 95. The bond has a fair face value of 100, but it is sold in the market for 95. Why it is sold in the market at a lower price? For several reasons, 2 very common reasons. Number 1, market interest rate goes up, bond price goes down. Always remember, market interest rate goes up, bond price goes down. Because what happens that this is a bond which is a 5-year bond and it is offering 5%. It is on investment of 100, it is offering 5%. If the market starts offering 6% return, the bank says, put money in our bank, I'll give you 6%. Then this bond, nobody will buy for 100. Everybody will start selling the bond and taking investment to the bank. And when people will start selling it, price will go down and probably this bond will be start selling for $98. This bond is no more in demand. Nobody wants to invest at 5%. And therefore, everybody is getting rid of that and the price will go down. Alternatively, if the market banks are offering only 4% return, so this bond now it becomes very much attractive. Everybody is taking money out from the bank and trying to buy the bond. So everybody says, oh, that bond is giving more return than the bank. So let me take out the money from the bank. I go to the market and I start looking for the bond. Demand goes up. And anyone who has the bond would start selling it for 102. So number one, that the bond price and the interest rate, they move in the opposite direction. This is one reason. Another reason is that let's suppose that market is still offering the same 5%, let's call it, but the bond price goes down to $90. It falls down a lot. And you say interest rates have not changed. Nothing has changed. Why it has gone down? Because of your credit rating. Before you were AAA credit rating, now you are A, because there are some risks which are associated, and your bonds have lost the credit rating. As the credit rating goes down, risk goes up. And when the risk goes up, investors, they start asking for more return. They are not happy with 5% now. They say, when it was AAA, we were investing in 5%. Now it is only A, we don't want 5%. They want more percent. So more percent cannot be given to them legally because it is only 5%. So what will happen? That the bond price will adjust itself to, for example, they say, oh, this is a AA bond, and the AA bonds should be giving 8%. Nobody would invest in single A. Nobody would invest at 5% because AAA was 5%. When it is A, it should give me 8%. So can I go and change this 5 to 8? Of course I cannot. Legally, it is only 5. Then how do I attract investors then? So market will adjust it. What market will adjust? Market will say this bond is now not 100. This bond will be sold at $90. And then what will happen? People will be earning $5 over an investment because this 100 into 5% will remain $5. So now this is an instrument which is giving $5, but this instrument is available in the market at $90, which will probably make 8% return. This is what the market has adjusted itself. Market has adjusted itself 8% because investors' end objective is 8%. So I would say from this bond, I need 8% return. You are giving me $5 only. So if I give you 100, that makes me only 5%. I don't need. I can maximum give you $90 for that. So that $5 return over $90 means 8%. This is what yield is. So if you ask me, what is the coupon rate? I would say 5%. What the bond actually is giving, the bond actually is giving 5 over 90, which is maybe 8%. This is yield. So yield is the real rate. Yield is the real earnings which an instrument is giving, okay? The real return. The real return is 8%. In terms of dollar, it might be, I mean, on the face of it, coupon rate is 5%. But in reality, I'm making 8% over that. So yield. Now, remember that if you see that this is 3 years and this is 5 years. For 3 years, it is 5.5%. As the time period increases, the yield increases. Because always remember in finance, we say that the farther we go into future, the risk increases. Because I can predict next 3 years, but it is hard to predict 5 years and even harder to predict 8 years. So when you say that, do you want to lock your money for 8 years? You start thinking. Because, okay, today it suits me, but will it remain suitable for another 8 years? So long-term investments, they have higher risks and therefore they offer higher returns. This is the normal yield curve. Yield curve normally goes up, okay? It goes up. Sometimes you might have a reverse yield curve. A reverse yield curve means that in the short term, it is giving more, but in the longer period, it will be giving less. So for 3-year period, it is giving 5.8%. For 5-year period, it is giving 4.5%. This is something which is a rare or a unique situation, and we call it reverse yield curve. And this happens when you realize that there are some difficulties in the current period, for example, COVID or whatever. So in the short term, there are difficulties, there might be less returns, but as the markets become normal, so we expect for the longer term investments. So we forget about that. So these are some credit ratings. You will go through that. Maturities, AAA, 3 years. You see what is happening here? It says basis point, yield spread. Yield spread means the difference between the risk-free rate and the actual yield. For example, the risk-free rate is, say, 5%. So this would be actually 5.18% it is offering, and this is actually offering 5.75%. When I say 18 basis point, 1 basis point is equal to 0.01. Okay, 1 basis point is 0.01. 100 basis point equals to 1%. And sometime you will see that some bonds or some companies or some entities, their credit ratings drastically go down. And suddenly they say that basis points have increased by 200 basis point, which means by 2%, which means that they should be giving 2% higher than the risk-free rate. So if you see that it is a 3 years bond with AAA rating, the risk-free rate was, if it was 5%, then this bond will be giving only 5.18, a very little difference, because it is a very healthy bond. But in case of a bond which is A, you have to pay 75 basis point above the risk-free rate, which means you would be offering 5.75. Below that, no investor will invest in your bond. And the difference between this 5 and 5.75, that is called yield spread. The difference between your risk-free rate and the actual offered rate. Okay. So this is the formula for WACC. I don't want to discuss it. We have done it at least 1,000,000 times in F9. So very straightforward formula, value of equity over value of equity plus value of debt, and you will take the market value of equity and debt into cost of equity plus value of debt into this, into cost of debt into 1 minus T, okay? And value of debt will be market value, okay? Value of debt or value of equity, you will take the market value. Okay, this is one question. We need to do this question. It says complete the calculations to estimate the total market value of Mantra company's debt. Okay, and what is the question? You see, it's a very simple exercise. This is not an exercise which you expect to receive an AFM exam at all. Never, never, never. But this is something like, you have got these small steps while climbing up. So it's a very small step. It's just the beginning of the course, day number 1 of the lesson. So this is something very simple. What we need to do, it says Mantra company's bonds have a nominal value of $100 and a total nominal value of 0.49 billion pounds, which means that 490 million worth of bonds we have issued. So we have issued 490 million pounds worth of bonds, where each bond is 100 pounds. The bonds pay a coupon of 6.2% annually. Further information on credit spreads and yield curve spot rates are given below. Okay, so when you have a maturity, 1 year, 2 year, 3 year, it's a AAA bond. It's a AAA bond. And for 1%, the yield spread is 8, which means that you have to, yield curve spot rate is 4.5. So 4.5 plus 8. So this is your market rate, yield, market yield. Add this 8 basis point because of 1 year. So the net return is 4.58. If it is in year 2, the yield spot rate is 5, which is the average market 5. The government, so yield is taken from the government bonds, okay? So the government bonds are offering 5%. You have got a AAA. So government is the safest one and the lowest one. And you would be giving 12 basis point above the government rate. So you are offering 5.12%. For 3 years, government bonds are 5.5. Your spread is 18, so it is 5.68. Now, these are the discount factors. Now, what are these things? These are the discount factors you are going to use to discount your cash flows in year 1, 2, and 3. What is year 1 cash flow? 6.2% over 100, which means $6.2 in year 1, $6.2 in year 2, and 106 because 100 you will return in year 3. And then you need to discount this cash flow. This is year 1, so you discount it with this cash flow. What is the factor? 1 divided by 1 plus 4.58 times 1. In year 2, 1 divided by 5.12 power 2. Discount factor I'm calculating. Okay, let me just take it to some Excel file and we will do it quickly there. Let me see if I can make a screen clipping here. Okay. Okay, so let me see if you guys can see Excel file, right?
Yes.
So what is the requirement in this question? The requirement, it says complete the following calculations to estimate the market value of the debt. We know that the face value of the debt is 0.49 billion, which means 490 million. But what is the market value? So nothing to be done. It's just year 1. I'll have year 2. I'll have year 3. Here it is 6.2 pounds I will give. And last year would be 106.2. And then I need to find out the discount factor. The discount factor in year 1 would be, okay, I'll just put discount factor formula first, just to show you people, so that you don't get confused. And then I will calculate that. I will do it in 2 steps, okay? So we'll take some extra time. So it says 1 divided by 1 plus 4.58%. And I will take it power 1, okay? Power 1, I'll take it like this. This is the formula I'm using for year 1. For year 2, the discount factor formula is always like this, remember? 1 divided by 1 plus I power n. This is what I'm doing. Instead of taking I, the cost of capital, I'm taking 5.12. This is my real cost. 1 divided by 1. Okay, I can just copy paste it here. And instead of 4.585, it was 4.58. Why did I write 585? I will write down here 5.12 and I'll call it power 2. Okay. Here I'll just remove 1.5. That 1.5 was extra. And then I will put it here. And in year 3, because of that longer time period, the yield is 5.68% power 3. Okay. So now what I do, I just copy paste it here and I am putting. So this line, I just put it here. To show you the formula so that you don't get confused. 5.68. Okay, so I put it here. And now these are my discount factors. So I forgot to put the percentage sign. Percentage. That's what I was thinking. That why these numbers are so small. There should be a percentage sign. And now I put equals to. And now I put equals to. So actually what I need is these numbers. These numbers. These are my discount factors actually. The first line which I put, I just showed you the formula, okay? So you will put the discount factors and then you will say the present value 6.2 into this one, and you make this one, and then you say how much is the present value total. That would be equals to the sum value of this one. Always remember, the market value of, whether you are calculating the market value of a bond or a debt or anything, is always equal to the present value of the future cash flows. If I say that this is a bond, what is its market value? So you will say the market value is equal to the present value of the future cash flows. So what are the future cash flows? 6.2, 6.2, 106.2. And then you multiply it with the discount factors, which you just calculated in 3 decimal places. And then you just multiply. It is 101.52. Remember, the face value was how much? The face value was 100. Market value is 101. So that's a good sign, actually. The cost to this business will go down. Actually, the cost to this business will go down than 6.2%. Because now they are giving 6.2% not on 100, but on an instrument of this one. And that's a good sign. If so, the total market value, and I would say that total market value of debt would be 0.49 billion multiplied by 101.52 divided by 100. So the proportion. So $100 bond is being sold for 101. I take the proportion, and when I multiply this thing now, so it is actually now 0.497 billion. So it is the total value of the debt has increased. Market value of debt is 0.497, not 0.49, 0.497. Why? So it was 490 million. Now it is 497 million because of the higher market value. Okay. So this is how to say a very short example for this type of question. We might have some other activities as well from this chapter, which I want to do with you, but that will take a little bit of more time. We can keep it for the next session. If you have any questions from today's session, you can ask, or otherwise, in any case, we are meeting tomorrow and we will do one question from VAC, and one question we will do very important from ratio analysis. And I will go quickly to chapter number 3. Anything you want to ask, please ask.